Thank you. So we're going to start the session today. I have a presentation to give, and then Chris and Roy will also present. And then if we have any time left, we'll do some questions and answers, and we'll take questions as well from the audience. So if you have any burning questions, feel free to ask us. So just to take a look at 2014, the current state of the industry as we ended the year, and one of the words that I described was hot. The industry did have a fantastic 2014. If you look across all of the regions, you see plus signs in front of each of the RevPAR figures. Now, I don't want to suggest that every single region around the world saw growth. We are still recovering in many regions around the world. But the US experienced phenomenal growth that was pure growth, and Europe continued to recover throughout 2014 and is in a fantastic position going into 2015. When we look at the reasons behind the strong performance, it really comes down to very, very favorable fundamentals. Across most regions in the world, we see that demand is outpacing supply. While we are still seeing supply growth is lower than the long-term average in the US. It is at the long-term average in Europe, and even in markets like Asia Pacific and the Middle East, where traditionally we've seen significant supply growth over the last 5 and 6 years, whilst we are still seeing that supply growth, it is coming in at a slower pace than we've seen historically. So very strong fundamentals in 2014, and incredibly strong demand. One of the critical drivers for that demand is certainly the number of international arrivals and the amount of travel that's happening. So over the course of 2014, there were more than 1.1 billion international arrivals around the globe, and Europe welcomed just over 50% of those arrivals. Europe is forecasted to welcome another 22 million arrivals in 2015, about a 3.5% growth. And the number of total international arrivals globally is expected to grow by about 5%. One point to mention, international arrivals into Europe, 82% of those arrivals are from other European nations. So certainly the continued economic recovery across Europe is very important to that sustained and continued growth for European markets. When we look at the way where Europe ended the year, in a constant currency basis, Europe was up 5% year on year. This is total year RevPAR growth. Phenomenally strong RevPAR growth, and what was most exciting for us to see is that for the first time in 6 years, this RevPAR growth was equally contributed to by occupancy growth as well as ADR growth. We're starting to see that pricing power, and we're starting to see rates lift. When we look across the 4 regions, you can see extremely strong growth, 7.7% in Northern Europe, driven by both ADR and occupancy. Southern Europe, almost as strong at just under 7.5%, also driven by both KPIs, both variables. Eastern Europe saw declines in occupancies, which did post RevPAR declines, and Western Europe has historically posted stronger ADRs, and whilst we saw flat ADR performance, we did see an additional 2.5% occupancy growth for Western Europe. And when we look across just a smattering of markets for Europe, there are a couple of trends here that I just want to highlight. And that is, in the US, if a market achieves 62% or greater occupancy, that is typically the trigger to then be able to execute pricing power. We do find in Europe that pricing power point is usually about 70% occupancy. And when you look at Southern and Eastern Europe, you see that we're almost at that 70% occupancy. And in fact, Lisbon and Prague are above that 70%. Rome is very close as well. So this indicates an opportunity when 7 out of 10 rooms for a market are sold. These are annualized numbers. There's that opportunity to push rate and to be able to price more effectively. And I do appreciate that Brussels is neither in Southern Europe nor in Eastern Europe. It's just where it fit in the chart, so that is the exception. My geography is not that bad, even though I am an American. When we move and look at Western and Northern Europe, I mentioned that we saw very strong growth in Northern Europe. We also saw that occupancy lift in Western Europe, and as you can see, those occupancy levels are north of 70%, north of 75%, and actually even north of 80% as well. So what does that mean? It certainly means that some of the stronger growth rates that we saw were coming from the markets which had the the easiest opportunity to lift. So again, Southern and Eastern Europe, we saw the strongest growth last year, certainly coming from a lower base. And while we did see strong growth in Western and Northern Europe, it was more modest and more moderate because we're operating from a higher base. And when we look across the various segments, what was most exciting to see is the incredibly strong performance of just under 9% ADR growth in the mid-scale and economy segment, and this is in addition to 3.3% growth in occupancy. Now, when we look across Europe, the mid-scale and economy segment are performing exceptionally strong in the UK and also in Germany as well, so really driven by the strong performance in those two countries. When we look at January, this is just the single month of January. It is in constant currency. When we look at currency adjusted, and when we actually don't hold for currency because of the Swiss franc decoupling from the euro, rates are about 9% when we look at RevPAR performance because we've seen so much movement in currency. So when we look at it on a constant currency basis, for the month of January, RevPAR was up 5.4%. This is the strongest January that we've seen in 6 years, so a very positive start to the year. And for Europe, this now means that we've seen 18 months of consecutive RevPAR growth, which is really fantastic. The US celebrated 58 months of RevPAR growth with a stellar January as well. So we're seeing some very strong performance and that consecutive growth. When we look across the supply and demand fundamentals and the supply and demand dynamics for Europe, Carrie was talking about the number of delegates here at the conference, and he had mentioned to me offline that the totals are now back to where they were in the early 2000s. And when we look at the demand percent growth, we find that demand for Europe is also back to the levels of the early 2000s. So there's some similarities between the hotel performance and what we're seeing here in this room today in terms of performance. So we're now sitting on an annualized basis with demand growth between 3% and 4%, which is where demand was sitting prior to the downturn, and it's very healthy growth for Europe. That supply component, the long-term average is 1%, continues to be 1%, and it continues to not be an issue and not impact performance as it hasn't in previous years. When we look at just a sample of countries, this is looking at index performance, January 2015 to January 2007. I think what's exciting to note is our host country is performing phenomenally well and has not only recovered from the financial crisis, but is outperforming previous RevPAR levels. UK performing phenomenally well as well. France has been flat from 13 to 14, but still is performing at levels above the previous peaks. And Hungary and Spain are also performing above previous peaks. There are some markets, Ireland and the Netherlands are very, very close to returning to previous levels, but they're still underperforming when we index performance back to 2007. And then you can see Czech Republic, for example, still has a ways to go. Something that's very optimistic, we look at the relationship between GDP forecast, and demand forecast and demand. And you can see that there's a very nice relationship between positive GDP or declines in GDP as well as demand for hotels. So looking across the Eurozone, looking at demand and GDP forecasts, the expectation is that demand will continue to grow and GDP forecasts certainly continue to be positive. So when we take the same principle and we apply it to different countries, but also look at the pipeline and what the expectation can be as it relates to new supply coming online, the UK has significant rooms in the pipeline at the moment, and very strong GDP as well. And with the exception of the UK, what we're seeing is significant GDP growth or good GDP growth for some countries because it has remained relatively flat over the past 5 years, and relatively stable and or nominal pipeline growth. So as economies continue to improve, as demand continues to improve, and as the pipeline remains relatively flat and the number of new rooms that are opening in each market, it creates better operating conditions and stronger fundamentals. So when we look across market by market, demand is illustrated in the yellow color and supply is illustrated in the purple color. And what we're showing here is the forecasted supply and demand growth for 2015. And with the exception of a handful of markets here in Germany where we are seeing significant supply come online, demand is forecasted to outpace supply across most European markets, which is really positive. The other negative there is Moscow as well. But for the most part, we are expecting demand to outpace supply in 2015. And when we look at the top pipeline countries, the top 10, UK, Russia, and Germany lead the charge. Russia, we are starting to see projects be deferred and even some abandoned, so it's uncertain how strong that pipeline actually is, and time will tell. UK, certainly with 45,000 rooms in the pipeline, Russia with about 25,000 rooms, and Germany with about 17,000 rooms really lead the way with some strong pipelines or modest pipelines in the other remaining countries. And when we look at the expectation for RevPAR performance in 2015, this word map illustrates by size of font the strongest RevPAR performance. Anything highlighted in green indicates positive growth, anything in red indicates negative growth. And the real takeaway is that we are expecting to see positive RevPAR growth across most major markets. We are expecting Dusseldorf to decline. That's really on the back of it being an events and a conference market, and they're biennial events. 2015 is not that year, so it's really more of a correction than a decline, and some slight declines in Stuttgart, Hamburg, and Prague. And as I mentioned, Moscow as well, we are forecasting to decline as the economic and the political situation continues as it currently does. So what does that look like from an occupancy and ADR perspective? When you look at this chart, it's hard to see each of those individual cities represented, but really the message here is anything that's above the line, above that 0 point, is ADR growth, and anything that is to the right of the y-axis is indicating occupancy growth. And while you may notice that there is forecasted declines in some markets, like Amsterdam, from an occupancy perspective, we are expecting that ADR lift to more than make up those slight occupancy declines. So I showed earlier there were only about 4 markets that were expecting RevPAR declines. This is just illustrating the makeup of the growth, whether it be ADR driven, occupancy driven, or occupancy and ADR driven. The 2 outliers there are Milan and Athens. Milan, we are expecting to see very strong performance, demand of about 7-8%, very limited supply, and that is as Milan plays host to the World Expo this summer, and really exciting opportunities for Milan. And Athens has posted double-digit, actually 30% RevPAR increases over the last year, and the expectation is that that growth will continue. It is very much a recovery story, but we expect that to carry on as well. And without further ado, I will turn the podium over to Roy, and he will share some thoughts on the investment environment.
Good afternoon. I thought that what I would do today is provide some context around the capital markets themselves, give the backdrop on the fundamental side. And I think what you'll see is that this is a moment that is as good as we've seen in a long, long time from a cost of capital perspective. And when you combine that with the growth that you're seeing in the underlying fundamentals, should be a great opportunity within the hospitality sector overall. What's driving it from a capital markets perspective? Specifically, there's so much liquidity in the system. We used to call it a tidal wave. I guess we could call it a tsunami now that we see all the Asian capital starting to come in. And it's been driven by and large by global quantitative easing. It started in the States as we hit the downturn and trying to, in essence, fuel a stable and recovering economy in the U.S., and now that has really spread across the globe itself. And there's this search for yield. At the end of the day, when you look at the CIO conundrum, if you will, the chief investment officer is looking for yield, global pension fund market that's looking for a 6.5% to 7% overall rate of return on a free and clear basis on a 10-year, roughly a 10-year. And you look at where rates are today, it's very, very difficult to get that out of the bond market The equity markets seem a little bit frothy, and at the end of the day, we're seeing it begin to just chase yield in those markets that can provide it. And you'll see that in not just in hospitality, but across the real estate markets in general, it's a great asset class at the end of the day. And there are improving, and I'll show you a slide on the number of capital sources that have returned to the market and are playing back almost to the peak, and the cost of financing is at a generational low. I referred to the global cross-border capital flow. It's increasing, and again, it's this search for yield. There's more and more geographies and more sectors in play, and specifically cities, as you'll see, are more important than their sovereign states. A place like Dublin, a place like Milan, a place like Madrid, a place like Barcelona versus their sovereign states themselves. And what's happening is there's a squeezing out as a result of scarcity in the major markets and major cities, and there is a migration into secondary markets and secondary assets. And that's also being driven by the fact that the debt markets themselves have also had to migrate as they've have to look for other alternatives out there. And then, of course, the exchange rates, which we think will ultimately drive a lot of travel in Europe and the UK in general. Here's the tail of the tape, and as you can see on a 5-year basis, we've gone negative in at least 2 of the markets and headed there in a couple others, and really nominal 10-year bond rates across the board. From the US, we sort of snicker at the fact that Spain and Italy are at less than 0.6% versus the United States at 0.51 for a 5-year bond, and under 1.3%, if 1.33% for the 10-year, when we're hovering around 2%. Obviously, there's a lot of capital being put into the system itself. And where's the capital flowing? And this is, again, a capital markets perspective, and that is a lot of increased investing activity in these European markets. The UK, Spain, and France, Germany, we probably expect, but you'll see Poland, Sweden, the Netherlands, Belgium, and Italy. And so we're seeing these peripheral markets beginning to recover quite nicely. The heat map on the right is the orange and sort of beige color ultimately show increases of anywhere from 50 to 100%, and the light blue being 0 to 20, and then the darker blue and very dark blue are declines themselves. And as you can see, those are in the markets that seem to be the most troubled. So when we look at these flows, and particularly from cross-border into Europe, prime yields in major cities are close to peak market, liquidity is increasing, heightened overseas interest from US PE firms as the opportunities in the United States are diminishing and that market's maturing, particularly in the real estate sector itself, where in virtually every sector, and most recently even the hospitality sector, which has been a laggard, the most economically sensitive, has finally gone back to peak pricing that we saw in 2006, 2007. And then there are those who are playing the cyclical lag that they see in the Eurozone. But $213 billion of global capital invested in the region in 2014. And when you look at the sort of top segment of that, that's North American is the largest with just under $45 billion invested. And then the Middle East, Asia Pacific, and Greater China. And then you'll see the domestic capital investing locally, led by the United Kingdom, Nordics, Germany, France, and then the continental cross-border, primarily UK, Germany, and France itself. And then this is, there was a reference about where the capital from Asia is going, and this is really kind of a trend line from 2010 to 2014. We see a strong increase as the regulatory environment and the government are encouraging outflows of capital. This is a recent phenomenon, really over the course of the last 10 years, but really increased in the last 2 to 3. And notably, if you put Asia into UK and Asia into Europe, you'll see that it's about $40 billion of capital flowing in, and a CAGR of growth of 18% as relates to Europe, and 44% over the last 4 years as it relates to the UK. Interestingly enough, 90% of that in the UK has come into London itself. Asia into the U.S. has been about $36.8 billion. A lot of that limitation has to do with FIRPTA, which is an excise tax for foreign investment, which many of you are familiar with. But again, over the last 4 years, it's increased about 74%. And then you'll see down Asia into Australia a significant amount, 53% over the last 4 years in terms of growth, about $26 billion, just about $11, $12 billion less than the U.S. itself, into a market that obviously isn't as broad or vast and without as much inventory at the end of the day. And what we've seen in terms of this capital, it kind of comes from three or four different segments. You've got the sovereign wealth groups that are out there mainly looking for platform types of transactions. Then you've got the more recent phenomenon of some of the Chinese insurance companies, so very institutional in that regard. Interestingly enough, having been involved in the Waldorf and the Baccarat transaction, these are chairman decisions. These are not institutional moves significantly. Having said that, most of those institutions who haven't participated with what are candidly 5, 6, 7, 8 of the top 10 players, the top 4 or 5 are actually looking at it and trying to figure out whether or not it's a phenomenon that they should be pursuing as well. And then you've got the operators, and then you've got the high net worth players as well. Most of them are looking for trophy assets at the end of the day. A lot of the operators are looking for opportunities to cross-sell residential as part of a hospitality package into their own domestic markets. So here's the surge, and again, the top line is domestic, the light blue line is continental, and the green line is the global. And you can see that from a domestic perspective, while we're not quite back to where we were in terms of volume by that group, we're getting fairly close. From the global perspective, we are at and slightly above where we were in 2007, and the laggard being the continental itself. Year-over-year transaction volume, which is the right-hand reference, is up 30% over 2014, and we expect in 2015, while this made up roughly 7% of the total, we expect that this is going to grow into somewhere close to 10% this year at the end of the day. Let me get back here. And this is what is driving a lot of this capital, in addition to just the search for yield. The underlying financing sources, which were primarily domestic within the region and provided locally, a lot more of it coming from the international markets, a resurgence in the CMBS market overall, and a lot of Asian capital, debt capital coming east to west, and from the U.S. markets west to east. It's more flexible, it's less structured, and what I would say is that the interest-only phenomenon is back and back in spades. And the all-in cost, while we don't expect it to go down that much more, as you can see in the left-hand bar, we're right at where, or we're lower than we've ever been. The spreads are wider, but the base rates are so much lower that people are borrowing at a much lower cost of capital than they've ever borrowed at before. And the right-hand bar is that if you focus on the purple line, you'll see that relative to where we were in 2007, we're roughly anywhere from 200 to 300 basis points below where we were in terms of borrowing costs. When you combine that low cost of capital with this underlying fundamental growth, we think that it portends very, very well relative to the opportunities that we'll see not only in 2015, but also beyond. So with that, Chris, I think that we'll turn it over to you. I think that you're going to have a few comments.
Thank you. Good afternoon, ladies and gentlemen. I thought I'd give you an opportunity to move your necks, so I came to this side. I'm going to focus predominantly on what's been happening in Europe and give you a few anecdotes which hopefully point you in the direction of where the market's going. And I'd like to start by just quoting what I said at the end of this little chat last year. Economic conditions are undoubtedly improving across much of Europe, but in particular in the UK. This will lead to improved trading performances in the hotels we are selling and valuing. This, allied to improving property values, creates a great opportunity for solid investment returns over the next 5 years. I think it's fair to say that investment returns have exceeded all our expectations over the last 12 months. It's been an extraordinary year, as we saw in the introductory slides, for hotel investment, not just in Europe, but across the globe. Global funds and private equity investors, notably from the US and Western Europe, have been particularly active. These funds and investors have substantial capital to deploy and are opportunity-driven. They will look anywhere that offers opportunity and value. Evidence of this can be seen in significant activity in portfolio and non-performing loan deals across Europe over the last 12 months. The UK in particular has seen unprecedented activity, with US investors leading the charge, keen to acquire existing platforms and benefit from the upward training curve. Deals have included De Vere Venues, which was acquired by Starwood Capital and now sits in their principal Haley platform. Hallmark Hotels were acquired off-market by Topland. The remaining QMH UK assets were acquired by Marathon Asset Management. LRG Tranche A sold to Q Green Hotels, and De Vere Resorts were bought by Sankati Advisors and Canyon Capital for their Q Hotels platform. Village Urban Resorts recently sold to KSL after a tough battle with Great Eagle, owners of Langham Hotels. And at the turn of the year, Lone Star surprised the market with the acquisition of a £1 billion portfolio from Moorfield Real Estate Fund, which included Shearings Hotels and a Mercure portfolio. This was soon followed by their acquisition of Jury's Inns in an accelerated deal process. And all of this activity followed on the heels of their acquisition of large chunks of the IBRC NPL portfolios, Rock and Salt. As we speak, more portfolios are being scrutinized by investors, including Jupiter Hotels, Malmaison and Hotel du Vin, and the European Host portfolio. Germany has also witnessed a number of key portfolio sales, including CITQ, Moorpark, Baladin, and FICO. In Spain, Project Octopus, the 4.4 billion NPL portfolio of former Euro Hypo, was sold to JP Morgan and Lone Star. And that comes on the back of the Nadal portfolio, which traded in Ireland. Pressure is on for most global investors to place capital before their funds reach maturity, and most private equity players are busy raising new multi-billion-dollar funds, which will undoubtedly underpin deal activity during 2015. European yields are still very attractive. The North American onslaught is augmented by Asian money, as we've just heard from Roy, driven in particular by Chinese investors. The Asian capital flows into Europe have really started. Deal activity will be greatly facilitated by the recent decision of China's Ministry of Commerce to ease restrictions and the approval process on outward-bound investments. The ongoing takeover of Louvre Hotels by one of China's largest hotel groups, state-owned Xinjiang, and the recent purchase of the Paris Marriott Hotel Champs-Élysées by Hong Kong-based investors are just two examples of the increasing appetite of Chinese capital and travellers for our region. I am sure that we will see an increasing number of Asian investors in this audience in the years ahead. Now to the burning questions of the Investment Forum. Where is hotel investment heading over the next 12 months? Is the market overheating? Are hotel assets overpriced? In our view, there is no sign that transactional activity will lessen across the whole of 2015. And you are all here to prove that. However, there may be a few bumps along the way. What do we see? Well, substantial NPL deals have been launched in Ireland and Spain, and we anticipate continued portfolio activity in Germany and increasing activity in France. We also anticipate a rise in the secondary transactional market as investors carve out non-FID assets and shape the core estates for future disposal. Investors looking for higher yielding opportunities will continue to watch Portugal, Italy, Greece, and Spain, and look further towards Central and Eastern Europe. As we hear throughout this conference, uncertainty remains around the global economy and the political climate. However, lower oil prices should boost travel and tourism. We also have a general election in the UK at the beginning of May, and this may well impact the market in the short term. The UK has been the engine of much deal activity in 2014, and prices have moved dramatically since 2013. We estimate over this period that prices have increased by over 20%. These price movements, improved trading, and an appetite to cash in have led to significant amounts of hotel stock being prepared for sale, being openly in the market, or being offered quietly to potential investors. We estimate that close to €5 billion of UK stock across probably 10 portfolios currently falls into this category. I sense that some potential buyers are becoming nervous and fear overheating. This is impacting their thinking around bidding. As I mentioned earlier last year, pricing and marketing strategy are critical. I sense that general portfolios are becoming a little less attractive and buyers are becoming more discerning. They are much more willing to look at individual and subgroup transactions once again, but nevertheless, quality platform portfolios will still be in great demand. I have no doubt that the underlying fundamentals are very positive, but I would urge caution in rushing assets to market in the UK before the general election. In my view, the UK will see higher values by this time next year, but patience may prove to be a virtue. I reiterate, to maximise price over this period, timing and approach to market are key. It's also important to note that different fundamentals apply across markets in continental Europe. In conclusion, the recovery curve across Europe differs massively from country to country, but there are still wonderful opportunities for innovative buyers. As yields compress in the more recognised real estate sectors, hotels continue to offer great value and very solid investment returns. I'm sure that many of you will make a great deal of money investing in our sector over the next 5 years. And what's more, it's really good fun. Thank you.
We are actually, we timed that so well that we are just at our 30-minute mark. So we'll have to excuse ourselves, but thank you very much, and we will see the next panel on stage. So thank you to Chris and thank you to Roy.
Thank you.